Hi, welcome to the SuperMacro podcast. My name is Elvis. This podcast supports the SuperMacro newsletter, which is available here. And with me today is Jonny Matthews, who's
Hi,
the
Elvis.
heart and hi, Jonny. He's the heart and soul of what goes on around here. Jonny, tell us what you want to talk about today.
Right, I really want to focus on the consumer, and I've got a bunch of charts that I'm going to go through today, which this is typical of the kind of stuff that you'll find in the daily newsletter. But I'm going to go through in some detail to explain why I think the US consumer is in pretty good health and there's no recession on the horizon, same as I've been saying for the past 2 years.
Just to be clear, everybody, this is not advice. This is just our own opinions.
Yes, and I hope you will enjoy the show, and please do check out the website and sign up for the newsletter.
Good morning, Jonny.
Morning,
Can I call you either Jonny or the recession denier? What would you prefer?
I'm all right with. I've been called worse.
Well, let's call you the recession denier. Jack Farley sort of gave you that acronym, and it sort of stuck with you. I know today you want to talk about the US consumer or the rude health of the US consumer. Without any further ado, tell us what's going on.
Yeah, well, I still don't see a recession on the horizon for the US economy. The consumer's in great shape. It's had, over the last year, there's been strong job gains, strong wage gains. Nominal household income is growing faster than inflation, has been for the past year. So I don't see any reason why the consumers should really suddenly come to a halt. And I can see behind me, we've got the chart of monthly job gains. Let's just start there. That's a good starting point. If you look at the US monthly payroll gains, I've separated them into two parts here. We've got the non-cyclical, the red bars, and you can see that is government, education, and healthcare. They're growing at about 100,000 a month, and that's fairly consistent, was consistent throughout the whole of last year. The cyclical sectors is pretty much everything else. That's mining, manufacturing, financial activities, and leisure and hospitality, pretty much everything else. And for a while, you can see it looked like these blue bars, the cyclical stuff. There was a slowdown in job growth in those sectors. But then in the most recent 2 months, in December and January, they exploded higher again. It's as if the US went through a small soft patch in the third quarter, and then growth picked up again.
Well, the question I've got for you is, and probably a lot of other people are listening to this podcast, is can this continue in the same way? Is this a short-term blip in cyclical job creation, or have we got genuine growth, i.e., unlike credit-fueled growth, we've got income gains that are spurring growth?
Well, yeah, you've hit the nail on the head there. I think household finances are in great shape. Unlike that period leading into the 2008 crisis, the household is not over-leveraged, and neither is the corporate sector. Today, I just want to focus on the household sector, where, let's just bring up the next chart. If you look at household net worth, this is just up to the third quarter of last year. And liabilities, which consist of mainly mortgage debt, haven't really grown much at all. But you can see the value of the household's assets have gone through the roof, particularly after the pandemic. You can see that blue line suddenly accelerates after the pandemic. And this is because equity values went, to the moon. But also house prices have been rising pretty strongly. We've had, if you look at the house price indices, they've shown month-on-month gains for the last 5 or 6 months now. So as far as the household sector is concerned, households are not over-leveraged. They're in great shape.
Sorry to interrupt you, Jonny. That looks, if you didn't show me what the title of that chart was, if that was a company, I'd be on the phone now to my broker trying to buy some. The liability is not increasing, but the equity is going through the roof.
Yeah, I mean, there is a slight increase in the value of the liabilities, but very, very, very little. And as you rightly say, the total net worth, we haven't had the update for the fourth quarter yet, but I suspect it's going to be something close to $180 trillion of household net worth.
Just a question I've got to ask you about this. I know this is a general, this is chart, this is a dynamic covering the whole of all the consumers, all the percentile earners, etc. So is this just the high net worth guys coming through with some big equity increases in property, or is it affecting all workers?
There was a study recently, a Fed study, I think the OECD as well. If you look at that, the increases in wealth, the percentage increases have been fairly evenly distributed throughout the income, the whole spectrum of incomes. And if you think about it, some of those households on the lowest incomes that, if they were owner occupiers of their houses, they had virtually no equity after the financial crisis, or even negative equity.
So this is a dramatic change, really, because that's been a complaint of the lower income percentile guys, that it's all been the high income guys, the wealthy guys getting wealthier, the middle class and lower class staying as they were, and the gap getting greater.
No, I think this rising tide has lifted all the boats.
Which is healthy, makes it a healthy economy.
It is very healthy. And, it's not like the consumers have leveraged themselves up. Let's just go on to the next chart. This is household debt expressed as a percentage of disposable income. So most of the household debt you can see is mortgage debt. But if you add all of it together, student loans, credit cards, auto loans, the whole lot, it was going up quite fast up towards the 2008 crisis. After that, it fell off. And if you look at it, really, it's on a slight downward trend, in all honesty. So, of course, most of it is mortgage debt. That red line, those are home equity lines of credit, HELOCs. And they were a thing in 2008, 2009. They're not anymore. That was back in the days when
get boat, get another boat. I need another boat.
Or jet ski.
Boat.
Just put it on the house. The house was like, just stick another 20 grand on the mortgage and go and buy a jet ski or a car or something. So really, household debt as a percentage of disposable income really hasn't gone up in the last decade or so.
To be honest with you, on Twitter, a lot of people talk about the size of the credit card loans, and that's what you would call revolving debt. And as you're probably going to point out, that it's repaid off every month, and the actual nominal amount isn't that great. But it's the auto loans, the delinquencies. Do they worry you at all?
No. You've touched on two subjects there that I'm going to come on to. So let's just first of all, I want to talk about the cost of funding this debt, because if you look at the total cost of funding all this debt as a percentage of household disposable income, it is as low as it's been in 4.5 decades. Outside of the pandemic period. So this is the household debt service ratio. It's the debt payments as a percent of disposable income. Still very, very low relative to where they were. Certainly relative to where they were in 2008, and low relative to the whole history that the Fed provides.
Do you know, this is going to bring me on to a question that's probably you want to answer maybe in 5-10 minutes, but I'm going to ask you anyway. It seems to me that the Federal Reserve, they've raised rates by some 530 basis points.
Well, 525.
525. Yeah. And it's made absolutely no difference to the consumer at all. In fact, the consumer's probably better off. If you've got a mortgage of 3% and cash in a bank, that's earning you 5%. What else? Happy days.
There are some fortunate people in that situation, but for most people, they have a mortgage and they have a student loan, whatever. But the rate is locked in on that mortgage. The average rate on all the outstanding mortgages is something like 3.7 or 3.8%. So a new mortgage is 7% now. That's the rate on a new 30-year mortgage.
Jonny, Fed funds has become a bit of a blunt instrument. Do you agree with me?
Yeah, absolutely. It has become blunted by what I would say years of abuse. You know, the decade of zero rates and successive rounds of quantitative easing that flattened the yield curve allowed consumers, allowed households and businesses to lock in ultra low rates. And so now the Fed has jacked up rates. It's having less impact than the Fed expected. Now, the Fed talks about long and variable lags in from the period when they first start taking the policy action to the time it has an impact on the economy. But the Fed did the first 425 basis points of hikes in this cycle before the start of last year.
18 over 8, need 18 months near us, damn it.
Yeah, I mean, there was another 100 basis points of hiking up to July of last year, but the bulk of the hiking was done before the start of last year. And you look at growth during last year, the second half of last year, growth was the economy was growing at an annualized rate of over 4%. In those last two quarters, annualized growth was faster than 4%. So
that's real growth.
Yeah, that's real growth, and not obviously nominal growth, closer to 7%. So you have to say, well, okay, by the end of the Q4, the rate hikes that they put in place 18 months earlier should have had an impact, but so far we're not seeing that.
So, all right, I know you want to talk about the consumer, but the question I have for you, assuming that we have this growth continue for the next quarter and the Fed start looking and thinking, maybe we can't really cut rates here. We'll kick the can down the road, maybe another 90 days, another quarter, etc. How high will rates have to go before they actually break something?
Well, it's not the Fed's intention to break something. They just want to get inflation back under control. Now, previously, they thought they would have to do that by increasing unemployment, slowing wage growth, which would slow services inflation. But so far, inflation has come down pretty quickly. I think most of the progress that they've made to date is kind of an echo of the supply chain squeeze. We had everything, prices of energy, prices of secondhand cars were going to the moon for a short period. And then last year, those effects reversed. I mean, used car prices were in free fall. They're still declining on a year-over-year basis, but those declines are coming to an end. Energy prices are roughly where they were a year ago, but obviously they declined a long way in the last few months relative to where they were the prior year. So I think the easy part of getting inflation down is over, and what the Fed is left with, what we're all left with, is a fairly high core.
Services.
Yeah, it's
try and book a holiday, try and get a
services.
restaurant on Saturday night, etc. It doesn't matter how much they raise their prices by. It seems to be locally. People still want to go out to eat. People still want to go on holiday. Don't mind paying the bigger prices.
Yeah, I think somehow, I don't know why, but consumers have got used to these higher prices. They're happy to pay them. The job market, as I showed on the first slide, is still extremely tight. Wage growth is proceeding at about 5% on an annualized basis. If you look at the more refined measures of wage growth, like the Atlanta Fed wage growth tracker. So, and household real disposable income, that is disposable income, less inflation, throughout last year was growing at roughly 4%.
It's amazing, isn't it?
Yeah.
So we haven't got a credit fueled growth with a liability that's growing and growing and growing. We've just got incomes growing, which are pushing the economy on and on and on.
Yeah, absolutely. But you occasionally you hear from some analyst who's done a chart of credit card debt going up and up and up, or something, auto loans or whatever. But this is really not a problem. If you I'll show you I've got a chart here. If you look at credit card debt, credit card loans as a ratio to household income, the percentage of household income, they've just sort of recovered to where they were in the decade or so prior to the pandemic, and they're nothing like as high as they were in.
This is key. Is the household debt to income ratio?
Absolutely.
The ability to finance your debt. It's always been the way. That's always been the key issue.
I mean, we've had high inflation, high nominal growth. Wages have got, nominal wages have gone up and up and up. Total household income has gone up faster than, some of these debts have grown. So, the household's really not in bad shape. And the same thing for auto loans. I know we've had a pickup in delinquencies, and that's, I would say, that's partly because, used car prices have been coming down, and perhaps people just hand the keys back and say, I don't want this car anymore.
Absolutely. In all the years I've been buying cars, you never, unless you're buying a classic car and you get lucky, you never make money out of buying a car. You lose money. It's just a question of how much you lose. That's why leasing and sometimes doing a PCP or something crystallizes your loss early. You know exactly what you're going to pay.
Yeah. But it's interesting, actually, the volume of car sales hasn't recovered to its pre-pandemic level. If you look at, it's not on this chart, but unit sales of autos reported by Ward. So if you look at the PCE expenditures on motor vehicles, it's not running at the same pace that it was prior to the pandemic. And so the actual amount, the total amount of auto loans, if you actually look at that chart, it's on a slight downward trajectory relative to incomes. So these, analysts can put up a chart showing credit card debt going up and up and up, but that's not the way to look at it at all.
No, absolutely. In nominal terms, is fairly useless. You need to see about, is it affordable? If it's affordable,
yeah, they're going to carry on doing it.
Going to carry on doing it. It's quite simple. Plus the fact, look, I don't want to go too deeply into credit card loans, but this is revolving debt. And a vast majority of this debt is paid off every month. So I assume this is a monthly what people owe.
Well, it's an outstanding. Is it the outstanding? It's the total outstanding amount.
Oh, I see.
So there's everyone pays off on a different day, and they don't necessarily all pay it down. A lot of consumers leave some on the credit card, but this is the net aggregate outstanding balance as a share of household income.
Can I ask you a favour?
Yeah.
Please don't show this to my wife, because she'll think she can spend more when she sees the credit card loans like that. Unbelievable. We're going to get another delivery from Amazon.
I'm pretty sure I would swap credit card debts with you in a heartbeat.
I'm not sure. By the way, is there some way I can sell cardboard? Because I've got about 3 ton of it at home from all the stuff that's been delivered.
Yeah. I think we're all in the same boat. Anyway, the point, I think the point that we're coming to here is that the Fed's policy actions to date haven't had that much impact on the household sector. They haven't on the corporate sector, but that's a presentation for another time.
Yes.
And I think...
But, Johnny, that's the question is really, what do they have to do to really affect household spending? Or is it not the Fed? Is it maybe the fact no more fiscal giveaways?
Well, I'll come back to the issue. They don't necessarily want to slow the economy down as long as inflation gets back towards their target. And in all honesty, I suspect that the Fed will not try to get inflation all the way to 2% if it means crushing the economy, if it means an increase in unemployment. If inflation gets down to, say, 2.5%, I think they'd be very happy with that.
So the inflation target's going to change?
They won't admit that.
Not implicitly.
Certainly not. They're never going to say that. But I think in reality,
that's the only way forward where we are now.
Yeah. And I think we're in an era of structurally higher rates. It's. I won't even call it the new normal. It's not the old normal. This is the normal.
The abnormal was 2010 onwards to 2020.
Yeah, this is the normal.
And it caused so many problems, and we're seeing that. That's probably where the next financial problems are going to arise from, all the cheap loans that were available then and the money and the gearing, etc., at ultra low rates. And now the financing's much greater. At some stage, we've seen that in the commercial real estate market, and the resets that are coming up are going to be painful. Is there any other areas that you're concerned about?
Well, look, first, let me deal with that first of all. There isn't going to be a cliff edge effect where all of a sudden everything resets and the whole economy, goes into a crevice. Each day, there are maturing loans that get refinanced for the household sector and the corporate sector. For the household sector, eventually these 30-year mortgages come up and get paid off, or get refinanced, or someone moves house, they buy a new house, they take out a new mortgage. So the average outstanding rate of mortgages is slowly creeping higher. You know, it's very slow. It's at 3.8%. The new mortgage is 7%. When someone takes out a new mortgage, that goes into the pool of outstanding mortgages and lifts the average rate. The same for corporate financing. You know, each week there's new deals that are being done at the current rate, but those deals are getting done. There's been a huge amount of investment grade issuance over the last couple of months, record amounts, in fact. So the deals are getting done, and corporates are managing. They're managing fine. It's a topic for another presentation. But if you look at the interest payments as a share of corporate profits, they're as low as they ever have been.
As you say, that's a topic for another time, or we'll probably maybe a topic for the next podcast. Just another chart you want to share with us, Jonny?
Well, yeah, I do want to just sort of summarize by showing this. This is the Goldman Sachs Financial Conditions Index, and this is calibrated to show the impact of looser financial conditions on a scale consistent with changes in the Fed funds rate. So, you know, when equity markets were sinking during October and the yield on the 10-year Treasury reached its peak and credit spreads were widening, financial conditions were tightening, it was having the equivalent impact of the Fed hiking rates. And it was then that the Fed started talking about the tightening of financial conditions and how that they may need to cut to offset that.
Can I just ask you a question? Most people have heard of the Financial Conditions Index. This is a Goldman Sachs version. What is just briefly, for people who are not aware of it, what's the makeup of this index? What's the main drivers of this index?
Well, there's a bunch of things that go into this. There's the yield on the 10-year Treasuries, there's credit spreads, there's the return on equities. You know, how much equities have gone up over the last, I'm not sure how they measure it over the last 3 months.
So the SPOO's going up is
a loosening of financial conditions, absolutely. So what we've had in the last 3 months or so is everything has been going better and easing financial conditions. We've had a strong equity market rally. We've had treasuries rallying up until the end of last year. And we had credit spreads tightening, and credit spreads are still tightening. The equity market is still doing fine.
So there's no risk at all. So you see,
I'm not saying there's no risk, but what I am saying is that the easing in financial conditions that we've had in the last few months is on according to Goldman Sachs on this scale, the equivalent of 3 25 basis point Fed cuts. And that's before the Fed starts cutting.
Jonny, we saw the Fed pivot last year, Powell's pivot last year to be precise, October, November. And we've seen since then, when the market was pricing, I think, 6.5?
Yeah.
6.5 rate cuts for this year, now down to, where are we? Just over 3?
That's right. And that was
that's a big change. What is it? One quarter. That's changed in 1 quarter.
I know. It's quite astonishing. But, and I said at the time in my daily note, I think I called it insanity at the time, pricing in.
Yes, you did.
7.
Yes, you did. You made a point of it.
Yeah. And of course, I had the trade on. The trade at the time for me, once the market started pricing in more than 5 rate cuts, the trade for me, the simplest trade was selling the DEC 24 SOFR futures. And of course, that trade went offside towards the end of the year. It got a bit painful and then came right the way back. The market, instead of pricing nearly 7 cuts, is now pricing, as you say, just over 3 cuts. I found my way on the trade. Just to be clear, I'm out of that trade, booked the profit, and that was a great trade.
It's incredible how the speed of the narrative of the market changes, like to have that many cuts removed, first of all added, and then removed in such a short space of time.
It was astonishing, but you've got to bear in mind, this kind of, I think the guy that kicked it off was Fed Governor Christopher Waller, and he made that speech. In fact, I think it was after he made the speech, and he was talking to journalists afterwards. He answered a question where he made the point that if the Fed doesn't cut rates while inflation is declining, then the real rate of interest is going higher and higher. And he said, that means we're probably going to cut in 3, 4, or 5 months.
Is that really a reason to cut? Because the real rate of interest is going higher, back to a level that it has been at for years prior to the financial crisis?
Well, Powell supported it. And then, we had all this talk of tightening financial conditions. The Fed was trying to find all kinds of reasons to justify rate cuts. And then then at the December meeting, we had the revised dot plots showing 3 rate cuts, and the market just took the ball and ran with it. As far as the market's concerned, right, the Fed's talking about rate cuts. That means we've got to price in loads of rate cuts, and of course, then the data didn't support that. The data that we saw just didn't support that. And the market's pretty much removed all those additional rate cuts and is now pricing about 80 basis points of rate cuts for
I
this
don't know
year.
whether you've got a chart at all after this, but what about rate increases in 2024? Chances of that happening?
I did have a chart showing the open interest on some of the options that would pay off in the event that the Fed doesn't cut at all this year. So there's been quite a bit of trading now in these out-the-money SOFR puts for December and put spreads, which would give a payoff. I mean, the payoff that you're going to get if you do, if you're successful, if the Fed doesn't cut this year by using those options, it's only about 5 or 6 to 1, something like that, which I don't think is a worthwhile trade. I mean, I think it's a tail risk that the Fed doesn't cut or perhaps they hike, but I would want to see a payoff of more like 10 to 15 to 1 to
Do you really think it really is 10 or 15 to 1? To me, with the data that's coming out, and if the Fed decided to get some glue and stick their hands to the chair and sit on them, you get paid a nice 5 or 6 to 1. Yeah.
Well, it's not only you that has that opinion. Obviously, the people punting in these options have got the same opinion. But for me, the way I'm positioned now in my portfolio, I think I don't like the risk reward of these short-term interest rate products as much as I like just being short treasuries.
Yeah. What, 5-year, 10-year, 30-year? Which one do you prefer?
Well, 30-year is less liquid. If you're trading the futures, it's less liquid and quite volatile. My preference is 10 years. I'm short the T-note futures. Nowhere near as big a size as I had at the start of 2022.
But it's different basis. You rates them. The yield on that, the 10-year was what, 1.2, 1.3%.
Yeah, that's right. It was like
it was nearly a no-brainer.
Yeah. To me, it seemed like a no-brainer at the time, and I had a very big leverage trade on that. But now I'm not over-leveraged, not overexposed to it. I just have a small short, which I'll run with because it's like I said before, I think we've entered a structural era of higher rates. We've got higher fiscal deficits. We've got more government spending on, green initiatives and the transition to a cleaner environment. More defense spending,
the IRA, the CHIPS Acts.
Yeah, these industrial policies, and we've got an aging population that's demanding more of welfare.
Less people working.
So these deficits, 6 or 7% is something that we're becoming used to, and at some point,
the shock absorber's got to be the currency, I assume.
Well, I don't know. I think partly the shock absorber is Treasury yields. I think it should be. Treasury investors should demand a higher yield to finance these deficits. You're right. But you're right. The currency, to some extent, which is it's if inflation stays high, then certainly the currency should decline.
That was going to be my question to you, which I think you've just about answered. How the US is the dollar is reserve currency. And essentially, they can do whatever they want as long as people accept that they're reserve currency and trust them to be the reserve currency. but is there a level of deficit where it becomes, because neither Trump nor Biden, who's going to come in, whoever one's going to win in at the end of this year, they both want to run high deficits. They both want to spend on different things, but they're both still going to spend. Is there a level of debt that becomes the market or the bond vigilantes get hold of it and really wring the neck of the treasuries and the
Very
currency?
different. Look, people have been claiming that the US is going to lose its reserve currency status for decades, and I don't think it's going to happen. To be the reserve currency, you've got to be a powerful country, but you've also got to have open capital markets. The US has got the deepest, most liquid capital markets. You've got to have respect for rule of law. You've got to have good governance. You know, the countries that are cited as potential candidates for taking a share of currency reserves, like China or Russia or India, are just nowhere near close to the kind of status of the US.
Fair comment. I think we're moving away from what we wanted to talk about, the health of the US. Oh, I assume you brought the dog with you today, Johnny.
Yeah. I couldn't.
You want to show Bluebell to the audience?
Okay. Bluebell, say hello.
Bluebell, say hello.
Yeah, I'm afraid since I took her to America, she's kind of been stuck to me like glue.
Yeah, okay, fair enough. For long, she doesn't make too much noise.
No, she's very good as gold.
Should you move on to the next? Have you got any other graphs?
No, I mean that's pretty much the whole of the slide deck. I think we've covered most things.
The important thing is for anybody listening, you've detailed where your position is at the moment, and that's still short treasuries in a much smaller size. Is there anything else you've got on in equities? Anything you want to share with us?
I've got a small position in European banks, pan-European banks.
Why is that?
Why?
Yeah,
because I'm still hoping for
because they're hoping for that rally. That it's the same as that recession in the US. It's never coming. Yeah, go on.
Well, I think if you look at valuations, which they're fundamentally so cheap, and the ECB has moved off this negative rates policy. Net interest margins have been climbing. Return on assets have been climbing. Return on equity is pretty solid. Capital ratios have been rebuilt. The banks are in great shape in Europe.
It's not really. It's just so struggle to make it into. The problem is I suppose from an investor's point of view, they've been disappointed so many times by being long banks. And the problem is also for governments. Banks are a nice target. No one feels sorry for banks when you tax them a bit more, when you regulate them a bit more, which will obviously hit profitability.
Well, let's be clear about this. We are not going back to an era where banks were earning 30% return on equity by leveraging up the balance sheet like crazy. That's not going to happen. The regulations that were put in place after the financial crisis have put a stop to that game. That's never coming back. But they are now, a 10% return on equity is quite feasible. But the bank, the sector, the European bank sector is valued at less than half book value.
Yeah. That's like the Chinese banks, which deserve to be at half book value.
It's
probably
a different thing.
There's
just different standards of corporate governance. And I think the other thing is that if you look at the earnings estimates for the banking sector in Europe, they've been growing very, very strongly. Now, I've also still, I'm struggling to get my head around the rally in US tech stocks. Obviously, I haven't been taking part in that, and I am still, if you look at implied volatility on the options market, it is still so cheap, on the S&P, on the major indices.
Right.
So I am spending a small amount of capital each week with some put spreads on the S&P.
It's interesting you mention that because, if anybody is long of SPOOs and wants to say long of US equities, a nice way to hedge that or to have some protection there is to buy some out of the money puts, which you've made a point of showing us in your note numerous times.
Yeah, we haven't spoken that much about the note. If anybody's listening into this and you want to try a free subscription, just click on the website. It's up there, www.super-macro.com. It's a daily newsletter with a weekly update that goes through what's going on, the implications of the economic data each week.
Yeah.
And talks about my trade ideas and my positioning. And so I update that each week. The portfolio is up over 8% since the start of this year, even with no positive exposure to the S&P. So do get yourself a free subscription, a free 30-day trial.
If you go on the website, you can see a picture of you and me. Isn't that fantastic?
Yeah,
Get that free of charge.
Yeah,
free of
that's
charge.
thrown in there for free. So yeah, please do subscribe, and you'll get an update on my thinking.
And they can see previous issues. I think there's 3 previous issues up there.
Yeah,
there?
there's some samples there. You know, check out the website. It's a new website. It's you'll see what we're all about.
Thank you very much indeed, Jonny, for this. I hope everybody's got something from this. If you want to contact us at all and ask Jonny some direct questions about what he's talked about here today, it's contacts@super-macro.com, and we'll get back to you as soon as we can.
All right.
Thank you very much. Cheers.
Thank you.